All right. Hi, everyone. We are live. Welcome to Market Matters. My name is Katie Kuntz, and I'm a social media editor here at CNBC. I'm joined by our senior markets correspondent, Bob Pisani. And today we're going to be answering all of your questions about the latest stock market moves. How are you doing, Bob?
Hi, Katie. How's things in Los Angeles? I'm here at the moment. I'm in Philadelphia, and there's a huge Eagles parade going on out not far from my door. So it's quite a celebration.
It's a great day to be in Philly. I'm originally from the Philadelphia area, so I wish I was there to celebrate with everyone, but I'm sure it's going to be a fun day.
Yeah, it's lovely. It's cold out, but it's bright and sunny. So it's a big day here.
Yeah.
Normally I'm at the New York Stock Exchange, but I'm in Philly today. So it's a nice day to be here.
All right. Well, we've got a lot to get into today, Bob. So first up, kind of just lay of the land. Where do stocks stand now?
Well, I just put a story out on our website saying essentially the market's continuing to broaden out despite the concerns we have. There's some very legitimate concerns out here about inflation persisting. We saw that with two reports this week with the CPI and the PPI, and both a bit stronger than expected. And that's created concerns about lingering inflation and about the difficulty the Fed's going to have cutting interest rates this year. And more importantly, the tariffs that's going on. And that's a real problem for the markets, because if they're fully implemented the way the president is describing them, this will definitely have an impact on earnings. However, the market's not acting that way. We are just shy of an historic high in the S&P 500, and we're shy of an historic high on broader indexes too, like the Russell 1000, which is twice as big as the S&P 500. That's also near a new high. So the market is acting like it's not terribly worried about inflation getting out of control, and not terribly worried that there's going to be full implementation of the tariffs. If there was, well, I think it would be a somewhat different story. I mean, we can talk about that if you want. But the important thing is, when we opened today, there was 3 stocks advancing for every one declining on the New York Stock Exchange, 2-1 on the NASDAQ. It's come off of that a little bit. But, given these overhangs in the market, things are holding up very well. It's all the more remarkable. We're halfway through the first quarter right now. This is a good time to look at how you're doing. And the leaders last year was technology stocks, but all the big leaders are doing nothing this year. So Tesla's down, Microsoft is down like 3 or 4%, Apple's down 3%, Alphabet's down, Nvidia's down, Amazon's up a little bit. The only big stock that's up notably is Meta. That's had an incredible run. It's been up days after days. It's up by 25%, but that's the one exception. Instead, with the S&P up over 4%, the market's broadening out, but not with tech. So material stocks are up. The stuff that lagged the worst performers last year, material stocks, healthcare stocks, energy stocks, real estate, consumer staple stocks, they're all the market leaders this year. That's called rotation. That's very, very healthy for the market. The problem we've had is we haven't had any rotation in a long time. We've had it for a few weeks and then it falls apart. Now we've got the whole first half of the quarter with this kind of rotation going on. That's a really good sign. So the average stock is doing really well. So there's 500 stocks in the S&P. About 2/3 of them are up this quarter. That's pretty good. The equal weighted ETF, the S&P 500 is market cap weighted. It's up, 4% this year, 4.1%. The equal weight, where you weight every one the same weight, is up 3.7% this year. That's about neck and neck with the S&P 500. So that's a good way of looking at the average stock. The advanced decline line has been good. It remember in December, January, we had a terrible time. More stocks generally drifted lower, and they've stabilized since the middle of January. So if you look at other indicators, momentum indicators like percentage of stocks above their 50-day moving average fell apart in December and most of January and has recovered now. Stocks above their 200-day average fell apart in December and January and have recovered in the last few weeks. So that's pretty good. So earnings for the fourth quarter have really been good. And there's only modest slippage for the first quarter too. So overall, I'm pretty optimistic about what's going on right now. So fourth quarter earnings were 3/4 of the way through. It's really been great. And the first quarter numbers are coming down a little bit, but not much. And so I guess my point here, and I said this before, is the market's acting like it's not terribly worried about things like tariffs or the Fed not being able to cut interest rates right now. It's really in a very good position.
So, Bob, you talked about inflation, the CPI report that we got this week. Let's circle back to that and just drill down. What did we learn from the CPI report, and what does that mean?
Well, we learned that there's still some pockets that are out there, some pieces of inflation that exist, and the PPI too. Fortunately, there's some signs that other things that were a problem last year, like rents, are probably going to come down a bit. Prices of goods, some goods are probably going to come down. Eggs have been a problem because of this bird flu epidemic, but that's probably going to get better. Services in some cases are still a bit of a problem, like insurance and things like that. That's proving to be very sticky. There's a thing called the PCE, which is the Fed's preferred gauge of inflation, and they measure inflation a slightly different way than the CPI. And there's some signs that the components of that will not be as bad. So I guess what I'm saying is it's very tricky looking at this inflation story. Some services inflation is still very, very high, like insurance, for example, and some healthcare, and others that are starting to moderate. But it's going to be a tough one to kind of get this down. Those of you who are thinking mortgage rates, for example, at 6.5%, 7% are going to come down. I hope they come down, but remember something. What was odd was mortgage rates at 3% a few years ago. That historically doesn't happen. When I got my first mortgage in 1985, it was 11.2%. That was normal back then. Today would be catastrophic. So the important thing is mortgage rates are more normal now. The 10-year yield at 4.5%, 4.7% is more normal. It's not normal to have a 10-year yield at 1 or 2% like it was a few years ago. That's terrible. You don't want interest rates that low. You want savers to get rewarded. Would you lend the U.S. government money for 10 years for a 1% return? I don't think so. That's a bad idea. So I know that it's causing some hardship with housing because you have a limited supply of housing. We need more housing. We need physically more housing. That's part of the main problem. It's constricted. And if there was more housing, the prices would come down a little bit more. And so it'd be more affordable, even with 7% or 6% mortgage rates. But again, these numbers that we're seeing here are much more normal than they were a few years ago. People have a recency bias where they think, oh, well, something happened 2 years ago and, heck, mortgage rates were 3%. They should be 3% forever. And that's not the case. So I know it's a tough time dealing with things like the housing market, but we're just going to have to work through it.
So we've also heard a lot about tariffs over the last couple of weeks. So what do President Trump's tariff plans mean for the stock market?
Well, we don't know. The problem is this is all transactional. So you see what's going on. The stock market's acting like it's not a problem. Let me give you an example. We're expecting something like 12, 13% earnings growth in the S&P 500 this year. If these tariffs are fully implemented, like 25% tariffs on Canada and Mexico, 10% on China, maybe more tariffs in Europe, there's been estimates that this could dramatically impact earnings overall. We could have, instead of 12 or 13% earnings growth, only 7 or 8% earnings growth. That's a big difference. I can assure you the market is not pricing that in right now. So what does it mean? Well, the market's sort of acting like it's going to be transactional, like the president is going to negotiate a deal where we're going to avoid most of these tariffs. I hope that's the case. I don't think they're necessary for this. I think they're good for leverage, but they're bad for the economy. Well, the market seems to believe that's going to happen. Let's hope so, but that's not a 100% guarantee. So there's some market risk here that exists in terms of impact. Remember, earnings is what matters here. If the stock market is a exchange that's a bet on a future stream of cash flow, usually in the form of earnings. So that's what matters right here. And the answer is we don't know, but the market's acting like long-term there's going to be some kind of deal where there's going to be very minimal tariffs. We'll see.
Well, another topic that we always get a lot of questions about is AI. So what do you think, Bob, of the AI bubble?
I'm not sure it's a bubble. I think there are a few stocks that are obviously beneficiaries like Nvidia, but I think this is truly revolutionary. I think this is like the internet 30 years ago. This is one of those once in a lifetime things that really changes everything. And it's not obvious about what this is going to do to your average company, but think about what happened 20 years ago with software as a service. So, 25, 30 years ago, there were a lot of companies that were still doing physical bookkeeping where people had books and there was a vast armies of bookkeeper. Well, software has replaced all those people. Whatever happened to them? Where did they go? Well, they found new jobs, but the accounting is now basically software work. You don't have people with rooms full of, physical ledgers. Maybe if you're running a pizza shop, you do, but, your average company doesn't do it that way anymore. Well, there was a dramatic increase in productivity as a result of that. Well, there are other areas where productivity is going to be gained by using AI. And that's what I think is going to happen. And a lot of this is still not obvious in terms of the impact on the average company. But I think it's going to help improve productivity. And that's the great mover here. So remember, how do you improve productivity? That's how you get earnings growth. That's how companies become more profitable. You either have more people, out there working. You have improvements in technology. You have population growth. How do you grow the pie? That's one of the ways to do it. And I think AI is going to have tremendous potential. We can get lost discussing this, but I'm a big believer that the real impacts of AI are still not fully apparent.
All right, Bob, and then our last question for today. Why is the New York Stock Exchange launching an exchange in Texas?
Well, it's not launching a new exchange. This week, the NYSE announced that they were taking an existing exchange they have, the NYSE Chicago, which is an old exchange. They bought it years ago. It's been around a long time. It's an electronic exchange, and they are moving it to Dallas, Texas. So they are literally physically transferring it. They're not creating a new exchange. They're taking an existing exchange, the one NYSE Chicago, and moving it to Dallas. First off, that exchange is largely electronic. Why are they moving it to Dallas? Well, was announced a year ago that there's a new exchange going to be created called the Texas Stock Exchange by new investors. These investors seem to believe that they can compete with the NYSE and the NASDAQ for listings, which is really kind of the lifeblood out there. And the NYSE and NASDAQ basically control all the listings for exchanges in the United States. There's no other serious competition out there. Texas is fast growing. There's a lot of companies listed on the NASDAQ and the NYSE domiciled in Texas. And some of them think that they can create a new stock exchange. There's money you can make around an exchange, around trading, around selling data that exists. So owning a stock exchange can be an individual enterprise that might be worth investing in. So big investors, big people who trade a lot, like Citadel and BlackRock, have been backing this. Largely because there's potential to go out and do something and invest in a new stock exchange if you can get a sufficient number of people to buy into it. It's unlikely the Texas Stock Exchange will be in existence before 2026. They've applied to become an exchange at the SEC, so we don't know anything about that. But this was clearly a move by the New York Stock Exchange to preempt that, to say, hey, listen, you can list on the Chicago Stock, you could dual list on the New York Stock Exchange in New York, and now the Texas Stock Exchange that the NYSE is setting up, you could dual list there too, and still have the same thing. So they're basically trying to preempt the competition. I think it'll be interesting to follow this. I'll be following this throughout the year.
All right. Well, that was our last question for today, Bob. So thank you to everyone who sent in questions. Thank you, Bob, for answering them as always. And hope you have a nice long weekend, and we'll see you in a couple weeks.
Thank you, guys. Thank you. Good questions as always.